Every trader dreams of freedom. The freedom to make money on their own terms. The freedom to control their time. And the freedom to prove they can win against the market. But behind this dream hides a silent challenge. The challenge of mastering the mind. Mark Douglas begins trading in the zone by revealing a simple truth. Most traders lose, not because they lack knowledge, but because they lack emotional discipline. They know what to do, but they cannot do it consistently. Fear, greed, and doubt take control. They jump into trades too early or exit too soon. They make the same mistakes again and again. Douglas calls trading the world's most honest mirror. It reflects exactly who you are. If you are impatient, the market will test your patience. If you are arrogant, the market will humble you. If you are afraid to lose, the market will show you loss until you learn to accept it. That is why success in trading is not about predicting the future. It is about understanding yourself in the present. He explains that the market is not personal. It does not reward effort, emotions, or intelligence. It rewards only discipline and the ability to think in probabilities. The trader who accepts uncertainty and controls their reactions gains true power. The one who fights the market loses to it. This book is not about a system or a secret formula. It is about changing how you think. It will teach you how to build a mindset that stays calm in chaos. A mind that focuses on process, not prediction. A mind that sees clearly when others are blinded by emotion. Each chapter in this book takes you deeper into the mental structure of a successful trader. You will learn how perception shapes reality, how beliefs create limitations or freedom, and how to develop the inner calm that leads to consistency. Trading in the zone means reaching a mental state where fear disappears, confidence flows, and decisions feel effortless. So before we explore the tools and techniques, we must understand where true success begins. Is it in the data, the charts, or the mind itself? Let us step into the first chapter. Chapter 1. The Road to Success. Fundamental, technical, or mental analysis. Every trader begins with dreams of freedom and wealth. They believe that success depends on knowledge, information, and skill. So they start collecting data, reading news, studying charts, and following experts. Mark Douglas begins this chapter by questioning that belief. He asks, if information and analysis were enough, why do most traders still fail? He explains that there are three main ways traders try to achieve success. The first is fundamental analysis. These traders focus on economic reports, company earnings, and global events. They believe that price reflects value and that careful study will reveal opportunities. But the problem is that the market does not always move logically. Good news can cause prices to fall, and bad news can cause them to rise. Because the market moves not on logic, but on collective emotion and perception. The second way is technical analysis. Technical traders study price charts and patterns. They believe that every piece of information is already in the chart. By reading past price behavior, they try to predict future movement. This approach can be powerful, but it is not enough on its own. Even the best patterns fail when a trader's emotions take control. Fear can stop you from entering a trade. Greed can stop you from exiting at the right time. The issue is not the method, but the mindset. That leads to the third and most important path. Mental analysis. This is the study of how your mind responds to the uncertainty of the market. Douglas says that trading is not really about the market at all. It is about your reactions to it. When you lose, you feel pain. When you win, you feel excitement. And both emotions can lead to mistakes. If you cannot manage your mental state, no system will save you. He gives a simple example. Two traders look at the same chart and see the same signal to buy. One acts calmly, following a plan. The other hesitates, overthinks, or enters too late. Both use the same information, but get different results. The difference lies entirely in the mind. Douglas says that new traders search for the perfect system, while professionals search for self-control. The professional accepts that every trade is uncertain. He knows that success comes not from prediction, but from probability. Each trade is only one small event in a much larger game. This awareness removes pressure and allows consistency. Most people lose because they do not accept how random the market truly is. They want control where there is none. They want certainty where only probability exists. This resistance creates frustration, confusion, and emotional pain. To move beyond it, a trader must change the way they think. They must stop fighting the market and start understanding it. Douglas teaches that the goal of trading is not to be right. It is to trade well. It is to follow your plan regardless of short-term results. Once you learn to think this way, every loss becomes feedback, not failure. Every win becomes confirmation of discipline, not luck. He concludes that mental analysis is the foundation of success. It gives meaning to all other forms of analysis. When your mindset is calm, your methods work better. When your emotions are balanced, your strategy becomes powerful. Trading then turns from a fight for survival into a journey of self-mastery. True success begins in the mind. And once you understand that, you begin to see trading differently. But what draws people to trading in the first place? What makes it both fascinating and dangerous at the same time? That is what Mark Douglas explores next. Chapter 2. The Lure and the Dangers of Trading. Trading looks like freedom. The market opens, and suddenly, you are the one in control. No boss, no schedule, no limit on how much you can make. That's the dream that attracts millions. The idea that with just one good trade, life can change. But this dream also hides one of the greatest illusions in human behavior: the illusion of control. Most people enter trading because they want independence. They want to break free from the limits of ordinary jobs. They see stories of traders who made fortunes, and they imagine themselves doing the same. The market becomes a symbol of possibility. Every tick, every candle, feels like a path to success. But the same freedom that attracts you also destroys you if you are not mentally prepared. Mark Douglas explains that trading is one of the few professions where the rules are completely opposite from normal life. In the world, discipline and control mean following fixed structures. In trading, discipline means staying calm in chaos. You cannot control the market. You can only control yourself. This is why traders who look for certainty often lose. They expect the market to behave in a logical way, but the market doesn't care about logic or fairness. It only reflects the emotions of all participants combined. The lure of trading is not just about money. It's also about excitement. Every trade gives a rush of adrenaline. It feels like power. You enter, the price moves, and your heart races. You feel alive. But this same excitement slowly turns into addiction. Traders start chasing the thrill instead of focusing on probability and process. The line between confidence and overconfidence becomes invisible. The danger begins when a trader starts believing that winning once means knowing the secret. They forget that markets are never predictable. One trade may work by luck. The next one might destroy your account. Without a strong mindset, success can be more dangerous than failure because it feeds illusion. A trader who wins early without understanding risk becomes blind to reality. Douglas emphasizes that losing is part of the game. But the way traders respond to loss defines their future. Some blame the market, others blame news or manipulation. But very few look inward. This refusal to take responsibility creates endless emotional pain. It leads to revenge trading, panic decisions, and impulsive bets. The market becomes a mirror that reflects every fear, greed, and insecurity you carry inside. The lure of trading lies in the belief that you can master it quickly. The danger lies in discovering that mastery requires unlearning almost everything you know about success. You must shift from trying to be right to managing risk, from chasing profits to protecting capital, from controlling outcomes to controlling reactions. Trading, at its core, is a mental game. Every trade tests your patience, humility, and ability to detach from results. It demands acceptance that anything can happen, no matter how perfect your analysis seems. The trader who survives learns to think in probabilities, not predictions. as Douglas prepares you for the next lesson, he makes it clear. Success in trading starts the moment you stop trying to control the market and start taking full responsibility for your actions and beliefs. The next chapter dives deeper into this truth. It explores how taking responsibility is not just a mindset, but the foundation of consistent trading success. Chapter 3: Taking Responsibility. In this chapter, Mark Douglas delivers one of the most powerful truths about trading. You are responsible for everything that happens when you trade. Not the market, not your broker, not the news, not other traders. Only you. At first, this idea sounds harsh. After all, the market seems unpredictable. How can one person be responsible for something that appears so random? But Douglas explains that responsibility is not about controlling outcomes. It is about accepting that you control your reactions, your choices, and your beliefs. When traders blame the market for their losses, they give away their power. They become victims of chance. But when you accept responsibility, you reclaim control. You no longer fight the market. You learn from it. You see that every trade is a reflection of your mental state. Douglas compares the market to a mirror. It doesn't judge or punish. It simply reflects the truth of who you are as a trader. If you are fearful, the market will show it through hesitation. If you are greedy, it will expose it through impulsive decisions. Every emotion you bring to the screen eventually turns into a result. Many traders enter the market hoping to escape responsibility. They want freedom without accountability. They dream of profits without patience. They seek certainty where none exists. But trading demands the opposite. The more you try to avoid responsibility, the more chaotic your results become. Douglas makes it clear that real traders don't focus on predicting the future. They focus on managing themselves in the present. The market offers endless opportunities, but it also tests your discipline. Every time you hesitate, overtrade, or break your plan, it's not the market's fault. It's your own internal conflict showing up in real time. Taking responsibility means owning your mistakes completely. When you lose, you ask why. Not to blame, but to learn. You examine your belief system, your emotional triggers, and your mindset. You begin to see patterns, not in prices, but in your own behavior. And once you recognize those patterns, you can start changing them. Douglas introduces the idea that traders must let go of the need to be right. In trading, being right does not matter if your risk is uncontrolled. You can be right 5 times and still lose everything on the 6th trade. The goal is not perfection. The goal is consistency, and consistency begins with responsibility. Every trade you take is a decision, and every decision is influenced by what you believe about the market and yourself. When you understand this connection, you stop seeing losses as failures. You start seeing them as feedback. The market is teaching you how to grow. Many traders repeat the same mistakes because they refuse to take ownership of them. They jump from one strategy to another, searching for the perfect system. But the truth is, no system can fix a mindset that avoids responsibility. The problem isn't the method, it's the trader using it. Douglas reminds us that the market has infinite potential, but only traders with a disciplined mind can access it. Once you take full responsibility, you stop trying to force the market to do what you want. Instead, you start aligning yourself with what the market is actually doing. This is the beginning of real mastery. By the end of this chapter, Douglas prepares the reader for a mental shift. Responsibility creates freedom. The moment you stop blaming and start owning, you begin to experience trading from a calm and confident place. This transition leads directly into the next lesson. Consistency, a state of mind. Because true consistency is not built from strategies or predictions. It is built from a mind that takes full responsibility, stays objective, and acts without fear. Chapter 4. Consistency, a state of mind. Consistency is the hallmark of successful traders. Most people misunderstand it. They think consistency means being right all the time. Douglas explains that consistency has nothing to do with predicting the market perfectly. No one can do that. Instead, consistency comes from controlling how you act in every trade, regardless of the outcome. A trader who is consistent focuses on the process. They follow rules, manage risk, and stay disciplined. They do not let emotions dictate decisions. Fear and greed are no longer obstacles because the mind is trained to respond the same way in every situation. This is what separates professionals from amateurs. Douglas compares a consistent trader to a casino. The casino does not win every bet, but it plays with the odds in its favor. Players may win occasionally, but the house always profits in the long run. Similarly, a trader must approach the market probabilistically. Individual trades will win or lose, but consistent behavior produces reliable results over time. The mind is the foundation of consistency. Most traders lose because they react to each trade as if it is life or death. A losing trade feels like failure. A winning trade feels like proof of skill. Both extremes trigger emotional reactions that disrupt discipline. To achieve consistency, a trader must create a mental state where every trade is just one of many. Douglas emphasizes that to be consistent, you must first accept the randomness of the market. No single trade is guaranteed to work. Accepting this truth removes fear and allows you to follow your plan without hesitation. When you stop worrying about being right, you start trading according to your edge. Your actions become deliberate and controlled. He also explains that consistency is not a fixed state. It is a mental habit that requires practice. The trader must constantly monitor emotions and thoughts. Awareness is key. Every time you notice fear, impatience, or greed, you have an opportunity to choose a disciplined response. Over time, these choices become automatic. Douglas points out that consistency cannot be achieved by imitating others. Watching someone else trade successfully can be inspiring, but copying their actions will not build your mental discipline. Each trader must develop a mindset suited to their own beliefs, fears, and strengths. This self-knowledge is essential. He reminds readers that losses are part of consistent trading. They do not indicate failure if the trader acts according to rules and manages risk. A consistent trader evaluates trades based on process, not outcome. This mindset allows them to stay calm during losses and avoid emotional decisions that could escalate mistakes. Douglas also addresses overconfidence, which can undermine consistency. Traders who experience early success often take larger risks, assuming skill alone determines results. Consistency requires humility. It requires acknowledging that uncertainty is always present and that control comes from discipline, not prediction. By the end of the chapter, Douglas shows that achieving consistency is about mastering the mind. It is about creating a mental environment where decisions are deliberate, emotions are neutralized, and rules are followed automatically. When a trader reaches this state, success is no longer dependent on luck. The chapter closes with a transition to perception. Understanding how your mind interprets market data is the next step. The dynamics of perception explains how beliefs, expectations, and mental filters shape the way you see the market and make decisions. This understanding is critical to sustaining consistency over time. Chapter 5. The Dynamics of Perception. Perception is how you see and interpret the world. In trading, perception is everything. Mark Douglas explains that the market does not present information in a clear, fixed way. Every trader experiences the market differently, depending on beliefs, past experiences, and expectations. Two traders can look at the same chart and see completely different opportunities. Douglas emphasizes that perception is not objective. It is filtered through your mind. Your beliefs determine what you notice and what you ignore. For example, if you believe the market is dangerous, you will see threats in every price movement. If you believe the market offers opportunity, you will notice chances to profit. Your mental filters shape your reality, even when the facts are the same. The chapter highlights that many trading mistakes come from distorted perception. Fear makes small losses appear catastrophic. Greed makes small gains feel like huge victories. Hope can blind you to warning signs, and frustration can make you exit trades prematurely. By understanding how your mind interprets data, you can begin to separate reality from emotion. Douglas also explains that perception is influenced by past experiences. If a trader once suffered a large loss, future trades may feel riskier than they really are. If a trader had early success, Future trades may feel easier than they actually are. The mind unconsciously projects past outcomes onto present opportunities, creating bias. The key to improving perception is awareness. A trader must observe their thoughts and reactions without judgment. By noticing patterns in your thinking, you can identify beliefs that distort reality. Douglas teaches that the market is neutral. It does not target you or anyone personally. It simply reflects collective behavior. Recognizing this allows you to see price movements clearly, without emotional interference. Douglas introduces the idea of mental rehearsal. By imagining different scenarios and practicing responses in your mind, you train your perception to remain calm and accurate under pressure. This reduces impulsive reactions and strengthens the ability to follow rules consistently. He stresses that perception shapes every decision. Even if your system is perfect, distorted perception can make you hesitate or overreact. A trader who masters perception can interpret the same information objectively and act according to strategy, not emotion. This creates consistency and confidence. Another important point Douglas makes is that perception is dynamic. It changes with mood, focus, and external events. A trader must constantly monitor their mental state and adjust accordingly. Awareness and flexibility in perception are essential to maintaining control in a market that is always changing. By the end of the chapter, Douglas links perception to belief. What you believe about yourself, the market, and risk affects how you interpret information. Changing perception requires changing beliefs. The trader who understands this can see the market as it really is, not as they fear or hope it to be. This understanding sets the stage for the next chapter. The market's perspective explores how the market itself behaves and how seeing it objectively can free the trader from emotional traps. Recognizing that the market has no intentions of its own is critical to thinking like a successful trader. Chapter 6. The Market's Perspective. The market is not personal. It does not know you exist. It does not care whether you win or lose. Mark Douglas emphasizes that this simple truth is the foundation of successful trading. Most traders take price movements personally. They feel insulted when they lose and overjoyed when they win. This is the root of emotional trading. Douglas explains that every trader brings their own beliefs and expectations to the market. When the market moves against them, it triggers fear, frustration, or anger. When it moves in their favor, it triggers greed or overconfidence. These emotions distort perception and lead to impulsive decisions. Understanding the market's perspective means stepping back and seeing it as neutral energy, without judgment. He compares the market to a mirror. It reflects the combined actions, decisions, and emotions of all participants. No single person controls it, and it has no plan or purpose. Prices move based on collective behavior. The market's neutrality means that losses are not personal failures. Wins are not personal successes. Both are simply part of the probabilistic nature of trading. Douglas points out that most traders fail because they fight the market. They try to impose their desires on it. They chase outcomes, predict trends, and resist uncertainty. The market, however, will not conform to their wishes. Resistance creates tension and emotional mistakes. Acceptance, on the other hand, creates freedom. When you see the market objectively, you can react calmly, make decisions based on probability, and follow your rules consistently. He introduces the concept of detachment. A trader must detach from the outcome of each trade. Detachment does not mean indifference. It means understanding that one trade does not define your ability or worth. The market offers endless opportunities. No single trade is vital. By letting go of attachment, a trader reduces emotional interference and strengthens discipline. Douglas also explains that thinking like the market requires awareness of patterns and probabilities. Every price movement is information. Every trend, reversal, or consolidation communicates behavior. A trader who adopts the market's perspective sees these signals without fear or greed. They focus on probabilities rather than certainties. This shift transforms trading from a reactive process into a controlled and deliberate act. He emphasizes that the market's perspective cannot be learned from books or charts alone. It requires experience, reflection, and self-awareness. The trader must practice observing the market without judgment, noticing emotional reactions, and adjusting their mindset. Over time, this builds mental resilience and clarity. Douglas concludes that seeing the market objectively is the gateway to the trader's edge. Once you understand that the market is neutral, unpredictable, and probabilistic, you stop reacting emotionally. You start thinking strategically. You stop trying to be right and start acting according to your plan. This understanding leads directly into the next chapter. The Trader's Edge. Thinking in Probabilities explores how adopting the market's perspective allows you to make decisions that are not based on certainty, but on calculated probabilities. It is here that mental discipline transforms into a real competitive advantage in trading. Chapter 7. The Trader's Edge. Thinking in Probabilities. Mark Douglas explains that trading is not about certainty. No trader can know the future. The market is always uncertain, and every outcome is possible. The key to success is learning to think in probabilities. Thinking in probabilities allows you to act logically, stay disciplined, and manage risk effectively. Most traders fail because they seek certainty. They want to know exactly what will happen next. They treat each trade as if it must succeed or fail based on their prediction. This approach creates fear, hesitation, and emotional decision-making. Thinking in probabilities shifts focus from predicting the outcome to managing the process. Douglas introduces the idea of the edge. Your edge is the advantage you have that gives you a higher chance of success over many trades. It is not a guarantee. It does not mean you will win every trade. But if you follow your edge consistently, your profits will grow over time. The trader who understands this edge is not worried about being right on each trade. They are focused on executing their plan correctly. He explains that probabilities are not about individual trades. Each trade is uncertain. You cannot know if it will be a winner or a loser. But over a series of trades, the probability works in your favor if you act according to your edge. This is the mental shift that separates consistent traders from inconsistent ones. Douglas emphasizes that to think in probabilities, you must detach from the outcome of each trade. Losses are natural and expected. They are part of the process. Wins are also part of the process. Neither should create emotional highs or lows. A trader who reacts emotionally to wins or losses loses control over their decision-making. He also points out that thinking in probabilities requires a change in mindset. You must accept uncertainty fully. You must recognize that the market does not owe you anything. You must stop expecting perfect outcomes. Once you accept this, you can follow your strategy without hesitation, avoid impulsive decisions, and maintain consistency. Douglas gives examples to illustrate how traders misinterpret probabilities. Many see a losing streak as a sign that the market is against them. In reality, losing trades are normal, even when you have an edge. Similarly, a winning streak is not proof of skill. It is simply part of the natural distribution of outcomes. Recognizing these truths prevents emotional overreaction. He emphasizes discipline again. The trader with an edge acts the same way in every trade. They follow rules, manage risk, and remain detached from results. This creates consistency, which is more important than being right on any single trade. Over time, the law of probabilities ensures that their edge produces profit. Douglas concludes that thinking in probabilities is the foundation of the trader's mindset. It allows you to view the market objectively, reduce emotional interference, and act in a calm, confident, and disciplined way. This is what creates a real competitive advantage in trading. The next step in building this mindset is understanding your own beliefs. Working with your beliefs explores how your personal perceptions and mental conditioning affect trading outcomes. By recognizing and adjusting these beliefs, you strengthen your edge and your ability to act consistently. Chapter 8. Working with your beliefs. Mark Douglas explains that beliefs shape how we see the market and ourselves. Every trader carries a set of beliefs about risk, money, success, and failure. These beliefs may be conscious or unconscious, but they always influence decisions. A trader cannot separate belief from action. What you truly believe determines how you react in every trade. He emphasizes that beliefs are not inherently right or wrong. They are mental filters that shape perception. If you believe the market is fair and opportunities are abundant, you approach trades with confidence. If you believe the market is dangerous or that you are likely to fail, fear and hesitation dominate your decisions. The trader's mind interprets the same data differently based on beliefs. Douglas points out that many traders unknowingly trade against their own beliefs. They create strategies, rules, and systems, but their emotions betray them. They may intellectually understand risk, but if deep inside they fear loss, they will overreact when trades go against them. This conflict between belief and action creates inconsistency. Working with beliefs begins with awareness. You must identify the beliefs that guide your thinking. This requires honesty and reflection. What do you really think about losing money? Do you see losses as failure or feedback? How do you feel when a trade does not go as planned? By asking these questions, you start to uncover the hidden forces behind your decisions. Douglas emphasizes that beliefs are learned. They come from past experiences, culture, family, and education. Some beliefs are helpful, others are limiting. The goal is to replace unhelpful beliefs with ones that support objective and disciplined trading. You cannot eliminate risk, but you can eliminate the fear that distorts perception. He also explains that beliefs create self-fulfilling prophecies. If you believe you are not a good trader, your behavior will reflect that belief. You will hesitate, overtrade, or exit too early. The market simply mirrors your mindset. Changing your beliefs changes how the market appears to you. Opportunities become visible, and risks become manageable. Douglas introduces exercises to work with beliefs. One method is mental rehearsal. Imagine trades going both for and against you. Practice responding calmly, following rules, and accepting outcomes. Over time, this trains your mind to act according to disciplined beliefs rather than emotional impulses. He warns that working with beliefs is not a one-time task. The mind constantly filters reality through new experiences. Old beliefs resurface under stress, especially after losses or unexpected events. Continuous self-awareness and practice are essential. Successful traders routinely examine their beliefs, adjust them, and reinforce those that promote consistent performance. Douglas concludes that beliefs are the foundation of the trader's edge. A trader with the right mindset sees probability clearly, acts without fear, and maintains consistency. By working with beliefs, you align your actions with your goals and reduce the mental conflicts that cause losses. This understanding leads directly into the next chapter. The nature of beliefs explores how beliefs form, how they influence perception, and why they are so difficult to change. Understanding this is essential for lasting transformation as a trader. Chapter 9. The nature of beliefs. Mark Douglas explains that beliefs are not random thoughts. They are mental structures that organize the way we interpret reality. Every trader has beliefs about the market, risk, money, and personal ability. These beliefs act like lenses, shaping every decision and action. Understanding the nature of beliefs is essential for mastering trading. Beliefs are formed from past experiences. From early life, we learn patterns of success and failure, reward and punishment. These experiences create expectations about how the world works. Over time, these expectations become deeply ingrained. Traders often carry beliefs that are outdated or limiting, even if they no longer reflect reality. Douglas emphasizes that beliefs are self-reinforcing. When you believe something strongly, your mind unconsciously seeks evidence to confirm it. If you believe that losses are devastating, your mind will notice every loss and amplify its emotional impact. If you believe that success is possible, your mind will notice opportunities and respond calmly. Beliefs shape perception, and perception shapes reality. He points out that beliefs are powerful because they operate mostly below conscious awareness. You may think you are making objective decisions, but hidden beliefs influence every choice. This is why many traders fail, even when they understand the rules. Their conscious mind follows a strategy, while their unconscious mind sabotages it with fear, greed, or hesitation. Douglas explains that changing beliefs requires conscious effort. You cannot simply tell yourself to stop fearing loss or to become confident. Beliefs must be examined, questioned, and replaced with ones that support disciplined behavior. This process takes time, practice, and self-awareness. The goal is to create beliefs that align with the probabilistic nature of trading. He introduces the idea that beliefs are flexible. They are not fixed truths. With consistent practice and awareness, traders can modify limiting beliefs and reinforce empowering ones. Mental rehearsal, reflection, and observation of emotions are tools to reshape belief systems. The more you practice, the more your mind naturally supports consistent trading behavior. Douglas also stresses that beliefs interact with expectations. A trader who believes the market is dangerous will expect losses, even when they are unlikely. This expectation changes behavior, often creating the very outcome feared. Similarly, a trader who expects opportunities sees them clearly and acts decisively. Understanding this dynamic is critical for gaining control over trading results. He highlights that beliefs are neutral in themselves. They are neither good nor bad. Their value depends on whether they help or hinder disciplined, consistent trading. A trader's task is not to eliminate all beliefs, but to adopt beliefs that enhance clarity, confidence, and emotional control. By the end of the chapter, Douglas prepares the reader to explore the practical effects of beliefs. The impact of beliefs on trading examines how specific beliefs shape actions, decisions, and outcomes. Understanding this connection allows traders to identify harmful beliefs and consciously replace them with ones that strengthen their edge. Chapter 10. The Impact of Beliefs on Trading. Mark Douglas explains that beliefs are not just abstract ideas, they directly affect every trade you make. What you truly believe about risk, money, and your ability to trade shapes how you interpret the market, how you act, and ultimately, how successful you become. The trader who ignores this influence sets themselves up for repeated failure. Douglas emphasizes that beliefs create expectations. If you believe that losses are painful and must be avoided at all costs, you will act cautiously, hesitate to enter trades, or exit too early. If you believe that winning is a result of skill alone, you may overtrade, take excessive risks, or ignore warning signs. These actions are not conscious choices. They are the natural outcomes of underlying beliefs. He points out that beliefs often conflict with conscious goals. A trader may consciously want to be disciplined, but an unconscious belief may resist it. This conflict creates inconsistency. Every time the unconscious mind dominates, fear, greed, or hope interfere with rational decision-making. This is why knowledge or systems alone cannot guarantee success. Mental conditioning must support your strategy. Douglas uses examples to illustrate the power of beliefs. A trader who fears being wrong may avoid taking trades, missing opportunities that align with their system. Another trader may fear missing out and take trades impulsively, ignoring risk management rules. Both are controlled by belief, not by rational strategy. Recognizing this is the first step to gaining control. He explains that the market responds to human behavior, not individual expectations. The collective actions of all traders create price movements. When your beliefs generate fear or greed, you react to these movements emotionally, often reinforcing negative outcomes. Awareness of this influence allows traders to detach and act according to rules, rather than impulses. Douglas emphasizes that changing beliefs is essential for consistent trading. Limiting beliefs must be identified, questioned, and replaced with ones that support calm, objective decision-making. For example, instead of believing that losses are devastating, adopt the belief that losses are feedback and part of a larger process. This shift transforms emotional reactions into disciplined responses. He also highlights that beliefs shape perception in subtle ways. A trader who believes the market is dangerous will notice risk everywhere, even when conditions are favorable. A trader who believes the market offers opportunity will see potential profits clearly and act decisively. The same price movement can appear threatening or advantageous, depending entirely on belief. Douglas introduces practical methods for transforming beliefs. Mental rehearsal, reflection, and observation of emotional reactions are key. By practicing responses to hypothetical market scenarios, traders can recondition the mind to act consistently under pressure. Over time, beliefs that support disciplined trading become automatic. By the end of the chapter, Douglas makes it clear that beliefs are the invisible force behind every decision. Mastering trading is not just learning strategies or systems. It is shaping the mind to support consistent, rational, and disciplined action. This leads naturally to the final chapter. Thinking like a trader shows how all these concepts, responsibility, perception, probabilities, and beliefs come together. It teaches how to act with confidence, clarity, and consistency in the market. Chapter 11. Thinking like a trader. Mark Douglas concludes Trading in the Zone by teaching how to think like a successful trader. Thinking like a trader is not about predicting the market or being right all the time. It is about adopting a mindset that allows you to act consistently, objectively, and confidently under uncertainty. This mindset is what separates consistently profitable traders from those who struggle. Douglas explains that thinking like a trader begins with acceptance of uncertainty. The market is always unpredictable. No matter how much analysis you do, no outcome is guaranteed. A trader who tries to predict results becomes emotionally reactive. A trader who accepts uncertainty can focus on the process, manage risk, and take advantage of opportunities without fear. He emphasizes probabilistic thinking. Every trade is just one event in a series. Success is determined not by each trade, but by how consistently you apply your edge over time. Thinking in probabilities removes the pressure of individual outcomes and allows you to detach emotionally. Losses are seen as natural and expected, while wins are confirmations of disciplined behavior. Douglas stresses the importance of mental discipline. The trader's mind must be trained to follow rules, manage risk, and act without hesitation. This requires self-awareness and practice. Emotional responses, fear, greed, hope, and frustration, must be recognized and managed. The disciplined mind acts according to strategy, not impulse, even under stress. He also explains the role of beliefs in thinking like a trader. Your perceptions and decisions are shaped by what you truly believe about yourself and the market. Limiting beliefs create fear and hesitation. Empowering beliefs promote confidence and clarity. Successful traders identify unhelpful beliefs, replace them with ones that support rational decision-making, and reinforce these beliefs through practice. Douglas introduces the idea of detachment from outcomes. Thinking like a trader means focusing on what you can control: your decisions, your actions, and your responses. You cannot control the market, but you can control how you trade. Detachment reduces emotional interference and allows you to respond objectively to every situation. He points out that thinking like a trader also requires awareness of mental patterns. Many traders repeat mistakes because they are unaware of their habitual reactions. By observing thoughts and emotional responses without judgment, you can identify destructive patterns and replace them with disciplined actions. Mental rehearsal and reflection are tools to strengthen this awareness. Douglas emphasizes that consistency comes from aligning your mind with the market. The market is neutral, probabilistic, and unpredictable. Thinking like a trader means seeing it clearly, accepting its nature, and acting according to rules and probabilities. This alignment transforms uncertainty into opportunity. Finally, he explains that thinking like a trader is not a final skill you achieve. It is a continuous process of learning, observing, and adjusting. Each trade is feedback. Each experience is a lesson. Over time, your mind becomes conditioned to act with confidence, discipline, and clarity. Douglas concludes that the true trader's edge is not in systems, indicators, or analysis. It is in the mind. Mastery comes from responsibility, awareness, disciplined behavior, probabilistic thinking, and beliefs that support consistent action. When a trader thinks like a trader, they enter a state of confidence and calm, the zone, where trading becomes both effective and sustainable. Conclusion: Trading in the Zone is more than a book about markets. It is a guide to mastering your mind. Mark Douglas teaches that the secret to consistent trading success is not in strategies, charts, or predictions. It is in the way you think, perceive, and respond. The market itself is neutral. It does not reward hope, fear, or desire. It simply reflects the collective behavior of all participants. Success comes from taking responsibility for your actions, understanding that every decision is your own, and that blaming the market or external factors only undermines control. When you accept responsibility fully, you gain freedom to act deliberately and objectively. Consistency is the next pillar. Douglas explains that consistent trading is a state of mind. It is not about being right every time, but about following a disciplined process and managing your responses to wins and losses. Emotional reactions, fear, greed, hope, frustration, are obstacles that disrupt consistency. Mastering your mind allows you to stay calm and act predictably, regardless of market movements. Perception and beliefs shape every decision. What you truly believe about risk, opportunity, and yourself determines how you interpret market information. Limiting beliefs create fear and hesitation. Empowering beliefs create clarity and confidence. By observing your mental patterns, questioning assumptions, and reshaping beliefs, you align your mindset with disciplined, rational trading. Douglas emphasizes thinking in probabilities. The market is uncertain. No trade is guaranteed. Success comes from understanding the edge, managing risk, and focusing on long-term outcomes rather than individual wins or losses. Detachment from outcomes, mental rehearsal, and awareness allow you to respond logically rather than emotionally. The ultimate lesson is that the trader's edge is in the mind. Mastery is not achieved by indicators or systems alone, but by training your mind to act consistently under uncertainty. When beliefs, perceptions, and actions are aligned, the trader enters the zone, a state of calm confidence, clarity, and focus. In this state, opportunities are recognized, decisions are made without hesitation, and the market becomes a reflection of disciplined thinking rather than emotional reaction. Mark Douglas concludes that trading mastery is a continuous journey. Each trade is feedback, each experience a lesson. By thinking like a trader, embracing uncertainty, and controlling your mind, you transform randomness into opportunity, fear into confidence, and inconsistency into reliable success. Trading in the zone is not about perfection. It is about mental discipline, self-awareness, and alignment with the probabilistic nature of the market. Achieve this, and the edge is yours.